Consequences of non-compliance, including case studies. If the failure to file SARs promptly or at all is based on ineffective company policies, procedures, and controls, the institution will face the consequences. The consequences when you fail to file required SARs are serious. The institution faces reputational risk, regulatory risk when regulators impose special audits, fines, or other regulatory sanctions, and criminal risk when charges are pressed. Individuals face the consequences, including getting fired, fined, criminally charged, and even banned from their occupation. Individual consequences are becoming more common in and outside the U.S. Thus, policy should be followed to avoid personal consequences. Let's hear a case study. In 2015, FinCEN penalized First National Community Financial Institution for $1.5 million for failing to file suspicious activity reports, despite significant red flags. According to FinCEN, the accounts in question were controlled by Michael Conahan, a member of FNCB's board of directors, who was also a Pennsylvania judge. Conahan and others were convicted in a judicial corruption scheme known as the Jailing Kids for Cash scandal, involving profiting from sending thousands of juveniles to detention facilities in which they had financial interests. Despite significant red flags, FNCB never filed a single SAR on these accounts until after Conahan had pled guilty. Here is another case study. In 2018, Capital One was hit with a $100 million penalty over several anti-money laundering breaches, including failing to file suspicious activity reports. The prudent regulator first raised the deficiencies in a 2015 order against the financial institution, highlighting weaknesses in its risk assessment, remote deposit capture, correspondent banking processes, and failure to file SARs. In 2018, it was announced that the financial institution failed to achieve timely compliance with the order, as required, and was therefore hit with a $100 million penalty. Lastly, let's hear a case study that includes personal liability. From 2003 to 2008, Thomas Hayter served as the Chief Compliance Officer for MoneyGram, a money services business specializing in money transfers. As part of his responsibilities, Mr. Hayter was responsible for ensuring that MoneyGram had an effective AML CTF program that included the timely reporting of suspicious actions and transactions. He was also in charge of MoneyGram's fraud department. During that time, there were thousands of complaints placed by customers who reported that they were victims of lottery or prepayment fraud and instructed to remit money to fraudsters via MoneyGram agents in the U.S. and Canada. Despite a lot of information from the victims, Mr. Hayter failed to implement an appropriate AML program, conduct effective audits, or terminate known high-risk agents. The failure to investigate resulted in the failure to file SARs. The consequences for the CCO were severe. FinCEN fined him $1 million in a civil penalty, and he lost his job at MoneyGram. FinCEN also sought to bar Mr. Hayter from working in the financial services industry. FinCEN said it pursued the case against Hayter and sought to hold him personally liable for sending a message to the industry. Thanks for watching this video, and I will see you in the next one.